Our speaker, Mr. Oluwole Oladimeji, is a seasoned finance, economics, and tax professional with distinguished careers spanning decades in the financial services domain and also in the energy sector domain, both locally and internationally. So please join me on the call to welcome our speaker for the night, Mr. Oladimeji Oluwole. You are welcome, sir. You are welcome, sir.
Thank you, sir. And thank you, everyone.
And we can see your slides right now. Thank you, sir. You can go ahead, sir.
Thank you very much. As has been said, we want to spend some time to look at the new tax laws in Nigeria, particularly how they affect us as individuals or people engaged in business.
Wait, sorry, sir. It doesn't look loud enough. Is it possible to maybe come near a bit or increase the volume to the maximum, please? It's not loud enough.
Is it better at this time?
Yes, it's better now.
Better?
Okay,
yes, thank you very much for this. Thank you for the feedback. As has been said, the objective tonight is to highlight the new tax laws in Nigeria, especially on how they affect us as individuals or as people engaged in or thinking of engaging in businesses. We will look at this in three major perspectives, under three major perspectives. One will be the overview of the reforms that gave rise to the laws in focus. We will also be looking at the implications on individuals and businesses, and then we'll be looking at a concluding part. In terms of the tax reforms, the strategic objective has been to streamline Nigeria's tax system by reducing the number of taxes to a manageable single-digit figure, to enhance revenue generation, simplify compliance procedures, and to address regional disparities in tax administration. And this objective, strategic objective, could be broken down into a number of elements, one of which is revenue generation and diversification, especially from oil to non-oil activities. Then another one is to simplify and to harmonize the various laws that we have. Some conflict, some are quite archaic, even in existence or created before Nigeria's independence, with English that is difficult even for lawyers to understand. Another objective, in terms of a further level of granularity, is to promote the ease of doing business and investment promotion, especially for small and medium enterprises, to remove what I can say, quote unquote, are nuisance taxes. In addition, it is to foster fairness and equity, because a number of people hardly survive, and yet they are being called upon to pay taxes, whereas some others who are relatively well off are outside of a tax bracket. So part of what the reform seeks to achieve is to, in fact, exclude the very low income earners from any tax obligations, and as we will see later, even to exclude small businesses from paying taxes at all, while trying to bring others outside of the tax bracket in, so that the government can still have revenues, but from people who have the capacity to really pay. Another element we will see has to do with improved governance as well as dispute resolution. The tax.
Sorry, sir, your slide is not moving. You are still on overview of the tax reform.
Yes, I will go into some details later. Yes, it's not moving by purpose.
Okay, noted, sir.
It's not moving by purpose. Thank you.
Okay.
And it shows that you are with me as well. So another aspect has to do with improved governance and dispute resolution. For the first time, we will see later the notion of a tax ombudsman, which is like an arbitrator that taxpayers can go to complain if they have issues with the way they are being taxed. Others relate to modernization and digitization, especially we will see later also the notion of e-invoicing and digital filing of tax returns. And we'll also see later that these reforms seek to make Nigeria to align with global standards, especially relating to the profit shifting protection and then the notion of a minimum tax. So here are some newspaper reports regarding when the president signed these bills into law. The bills were sent to the National Assembly late in 2024, and based on the administrative processes for passing the laws were signed by the president in June, and the official gazette releasing them came out officially in September of this year. Now, this slide provides an overview of the 4 tax acts in focus. These acts have been enacted within the framework of a broader economic stabilization bill, which is still in progress, which will lead to some other laws. But these ones have already become acts. There are 4 of them. The first one is the Nigerian Tax Act. The second is the Nigerian Tax Administration Act. The third is the Nigerian Revenue Service Act, while the 4th is the Joint Revenue Board Act. The last 2 have to do with organizations that will give effect to the laws, which essentially we have in the Nigerian Tax Act, and how that will be administered. So you will notice here that the commencement dates were in June, in order to enable those bodies to be created and to be ready for when the real acts themselves relating to imposition of taxes and collection of taxes will become effective on 1st of January next year. I've already talked about the strategic objective in the previous slide. Now, diving in a little bit further, this represents Nigeria's most comprehensive fiscal reform. And we will see that it consolidates previously scattered tax provisions into a unified, coherent framework. Today, if you want to understand Nigerian tax laws, you will need to get this act here, get another one here, get another one here, get another one here. But now the Nigerian Tax Act has brought all of them together into a single act. So whether it is personal income tax you are interested in, company income tax, value-added tax, or some others, you can pick up this act and you will find all the details in there. Then, apart from the laws themselves, we have the Nigerian Tax Administration Act, which has to do with standardized procedures for administering this tax or these taxes across all levels of government. Because it's one thing to have the laws, it's another thing to know exactly how will this be done. Who, for example, is supposed to file, how is the filing supposed to be done, and all that. And as we look at this, we will also see that there is a decisive shift towards e-governance. If you are been following up the news recently, Nigeria just signed an agreement relating to fiscal cooperation with France. And part of that is meant to give effect to collaborative activities as well as digitization, which is a decisive shift coming from this act, especially the Nigerian Tax Administration Act. Then, apart from the act and how it to be ministered, we have the Nigerian Revenue Service Act, which is the organization on the government side that is responsible for effecting this. This replaces the current Federal Inland Revenue Service Establishment Act and introduces a number of changes, which we will see later, like making the NRS now to be the agent for administering all revenues going to the government. So you discover that some things today that are payable to some entities like NUPRC will now be collected by the Nigerian Revenue Service, which has been empowered, enhanced, more funded, and placed in order to carry out its activities. The last has to do, the Act, the Joint Revenue Board, has to do with the process in case you have disputes, which is not uncommon in tax administration. So it repeals the Joint Tax Board, which is the agency that people could go to the Tax Appeal Tribunal if you are not happy with what the tax authorities have access to by or which they have said. So this now introduces a broader and more efficient framework that should enable tax disputes to be resolved more readily. Of particular note is what we are having for the first time in the Nigerian tax landscape, the notion of a tax ombudsman who will serve as an intermediary between the taxpayers and the tax authorities. And you don't have to pay him for him to do this, to represent you if you feel that you have a grievance with the tax authority for one reason or the other. We have Dr. John Nwabueze, that's a typo there, who has been appointed into this position. And the essence basically is to strengthen transparency, accountability, and public confidence in Nigeria's tax system. This slide is essentially coming from the Presidential Committee on Fiscal Policy and Tax Reforms, giving an overview of the roadmap from when the bills were at draft stage to when the president, that's number 2 on this slide, transmitted them to the National Assembly for passage. Number 3, based on the processes at the National Assembly, the first reading, the second reading, which led to committee review. And then after that, you had the third reading and the final passage by both chambers of the National Assembly. Because they had different versions, they had the Harmonization Committee, which now came out with a harmonized version of the bill, and which haven't been presented thereafter to the president. The president has assented to, as I said earlier, on the 26th of June. So where we are now is in readiness for when the implementation of these acts will be from 1st of January. And at this time, various bodies are working in order to have regulations, guidelines, and other matters relating to these implementations ironed out, addressed. Now, our interest, particularly in this forum this night, what are the implications of this act for us as individuals as well as businesses? I would like to start with personal income tax. Essentially, all salaries, wages, fees, allowances, compensations, bonuses, premiums, benefits, and other perquisites allowed, given, or granted by any person to any employee, other than like reimbursable expenses, which is not meant to make any profit will now be subject to tax. And in terms of who is subject to tax, the employee can be resident in Nigeria. The employee, if he performs the duties of the employment either wholly or partly in Nigeria, then the remuneration paid on behalf of such an employee will become taxable, deemed to be derived in Nigeria. And the Act, the NTA particularly, also talks about the role of the employer to deduct from the emoluments of his or her employees what is due to the government and also to remit same. So if you are an employee and you are earning taxable income, then you will be subject to tax. And if you are an employer, then you have an obligation to deduct and to remit to the government based on what you pay to your employees. This takes a further look at this. When we talk about employment income, who is responsible to do the filing and at what frequency? So the employer, as we said before, has a responsibility to deduct this. I want to highlight this benefit in kind. This means that when not real money is paid, but the employee enjoys some benefit, then the employer has a responsibility to use like the market rate attributable to that and the gap between that in order to denominate such a benefit for tax purposes, even though real cash was not involved in that particular transaction. The employer has a responsibility to do this on a monthly basis, given that in Nigeria, essentially, salaries are paid monthly. But apart from that, an individual may earn income other than employment income. The employer's responsibility stops at the employment income. The employer is not responsible to know whether somebody has invested and bought shares and is earning dividends, whether someone has a landed property or has a property which is generating rental income on, or some other things. So as individuals, apart from the filing that your employer will do for your employment income, you have a responsibility, if you have other incomes other than that, to declare those yourself alongside what your employer would have done. So depending on the nature of the transaction, some of these other items could be per transaction or essentially annually on or before 31st March of each year. So the employer on his own side will do his own filing in January, but you as an employee, you have up till the end of March to do a top-up one if needed to complement what your employer would have done on your behalf for the employment income aspect. I'm trying to go to the next slide. It doesn't seem to be moving. Why? Okay.
Yeah, thank you. Okay, that's okay.
So, thank you. Now, moving forward, it seems as if I've moved too fast. Okay, it's fine. So, in terms of the impact, there are some reliefs. Reliefs means that it's not It's not your total income that is subject, your gross income that is subject to tax. There are some reliefs, which means that you can claim some things if applicable, and you can activate this if beneficial in order to manage your tax exposure. For example, if you have an owner-occupied house and you take a mortgage and you pay interest on that mortgage, then you can file for relief for the interest that you pay on that mortgage to finance your owner-occupied house. And that will be deducted from your gross income before the determination of what will be the basis for applying a tax rate. Also, you could decide to take life insurance policy. In this, be careful you don't take an insurance policy that is both like life and investment, because the tax authority will probably disallow that. It should be for life. So if you take a life insurance policy on yourself, then the cost of that, you can also claim it as a relief. And if you are under a contributory pension scheme, then the contributions you make to your retirement savings account will be deductible. So you may want to consider, if you are not doing that at the moment, whether it's worth your while taking on some of these things, knowing that they would lead to a lower base for your tax determination. In terms of pensions, gratuities, and retirement benefits, these are exempt from PE. And depending on tax rates, some people retire, and when they retire, their disposable income is higher because they've been paying taxes before, and now they're not paying taxes anymore. And because of that, they may have, depending on their pension, if they are under a defined benefit scheme or so, they may actually be earning more than when they were in service. Today, there is a notion that is the personal allowance, which is 20%, as well as a consolidated relief allowance of 1%. This will no more be available under the new Tax Act. What the Tax Act provides, effective from January next year, is a rent relief, which is capped at the lower of 500,000 or 20,000 of the rent paid. So if you pay rent, then you can up to 500,000 or 20% of the actual rent paid claim a relief based on that, but you will need to support that with relevant documentation. Then, in terms of individuals that receive compensation or damages for personal injury or loss of employment, for example, up to 50 million naira, that will be exempt from tax. But if it's above that, then the excess will be subject to tax. Now, there is the tax identification number, which is meant to be unified for every person to have this number. We will still have further clarity regarding how this will be operated in terms of those that have things today. For example, today, if you work in, let's say, Lagos State, you get one from Lagos State. If you are transferred to, let's say, River State, you get another tax ID from River State, different from that which is in Lagos. The Act seeks to unify all of this such that it will be a unique tax identification number all across. But we've been hearing that maybe people will retain the numbers they have now, and maybe those who don't have will only be issued. So some clarity is still needed on how to operationalize this. But the essence basically is that everyone who will be subject to tax in one way or the other will have a tax number. And if we look at the aspect of reporting by financial institutions here, now banks, insurance companies, and stockbrokers are required to notify tax authorities when an individual has cumulative transactions of more than 25 million on a monthly basis. So for those who might be in that category, know that information relating to this is required by these companies' entities to be provided systematically to the tax authorities. I talked about the benefit in kind before. Let me talk about the presumptive tax regime. Exactly what this says is, if you are expected to file tax returns and you do not, and maybe the tax authorities have reason to believe that you have income that you have not declared, maybe you have a property and your tenant, in order to claim this rent relief, files for this rent relief of 500,000, and it provides a document and a rental agreement showing that you receive the rental income, then the tax authority can come after you on that basis, even if you have not done a tax filing, to charge you based on presumptive taxable income, based on information they have or what their belief is. Maybe somebody says they doesn't have income, and then the stockbrokers, the banks, they are sending to the tax authorities movement that this guy has movement in his account of more than 25 million. Then they can as well call the person and assume that, okay, it's because you are earning income from this and that. So just be aware that even if you do not file any tax, the tax authorities are now empowered by law to use like a best of judgment to apply a presumptive taxable income. And in that case, the onus will now be on you to prove otherwise. Otherwise, it will be binding. Some other aspects in terms of capital gains tax. If you have a personal dwelling house that you dispose of, then if you make gains on that, what it costs you to buy it, and then what it costs you to sell it, to simplify things. If it's your personal house, then there's no capital gains tax due on that. If you are an investor in shares in Nigerian companies and then you sell, you do not have to pay capital gains on the disposal if certain conditions are met. For example, if the aggregate proceed is less than 150 million and the chargeable gain does not exceed 10 million in any 12 consecutive months, then you don't have to pay capital gains. Or if you choose, if these thresholds are surpassed, to now reinvest those monies, then you will not need to pay capital gains. So having this knowledge can help us in terms of what we choose to do or not to do, in terms to manage our tax exposure legally. This is not talking about tax evasion. Then I talked about the Office of the Tax Ombudsman, which is novel, and is to assist and represent individuals to ensure that they are not being extorted by the tax authorities. You don't have to pay for these services. You can go to him and table your case and seek needed support. So it won't be the might of the tax authorities against, quote unquote, your poor self alone. And then if you dispose personal chattels, then those are also exempted from capital gains tax. If you dispose personal properties and the amount does not exceed 5 million or 3 times the annual national minimum wage, whichever is higher. National minimum wage now is supposed to be 70 40,000 per month, about 40,000 per year, though it's not sure this is the case in all jurisdictions at the moment. Now, this slide tries to give an idea for personal income tax rates, where we are today and what by the left and where we will be from next month. I want to highlight that this deals with chargeable income. It's not your total income. So as I said before, your total income, you can claim some reliefs, insurance, mortgage, interest, and all that. So this table is based on chargeable income after you have claimed all those reliefs. Today, if you look at the left side of this table, you will see that we have a progressive tax rate. You will notice that the tax rate increases as the level of the chargeable income of the taxable person increases, with the highest being at 24% for those that have chargeable income of over 3.2 million. And if you look at this left side still, you will see that it starts from 7%, meaning that no matter your level of income, the minimum rate will be 7% based on your chargeable tax. But if you look at the right side, you will notice that the rate starts from 0% to 25%. So what does this mean? The government has realized that, look, many people are trying to survive. Food, housing, healthcare, and all that. Don't let's unnecessarily burden these people anymore. Let them even try to survive first. Then, when they are surviving, they are earning more income and all that, we can begin to tax them. But at the same time, you will notice on this right side that the rate has gone up to 25%. And they're essentially saying, well, those that earn more, let them also pay more. Instead of the highest rate of 24% before, we now have 25%. And on the average, for someone to, on this right side, to go beyond this 800,000 per month, taking into account the reliefs he may have earned and all that, the person would be earning about 20 million in total, depending, it can vary. But the point I'm trying to make is essentially, if you're not earning 20 million or more, you may not experience a higher rate under this new tax regime. And if you are a low income earner, you probably may not have to pay any rate. So how it affects individuals will vary depending on exactly where you are, income bracket, and the reliefs that you can claim or not. Now, I think this should be of interest to us in terms of income exempted from tax, because not all incomes, it's not just because I earn income that I have to pay taxes. If the income relates to a statutory or registered society, then it's exempted. If it's a cooperative society registered under any enactment or law relating to cooperative societies, same treatment. Religious or charitable activities of a public character, that is also true. Trade unions also. Agencies, ministries, departments of government, and other public institutions, yes. As I said earlier, pensions, gratuity, retirement benefits that are granted in accordance with the Pension Reform Act. Then, if we have pension funds and assets that are approved under the Pension Reform Act, then the income they generate will also be exempt from tax. And if you have a sum that you receive by way of death, gratuities, or as consolidated compensation for death or injuries. And as mentioned before, redundancy lump sum payments and other compensation of capital nature for loss of employment. For those who are in the armed forces, military officers, then their emoluments would be exempt from tax. If you have dividends, and I think this might apply to a number of us, interest, rent, or royalty that you derive from outside Nigeria, and you now bring it in through approved channels, essentially through the formalized banking system, then that will not be subject to tax when you bring it into Nigeria. Then if you give gifts, provided that the recipient does not sell it, then that gift would be exempt from income tax. And if you sell your personal vehicle, emphasis personal vehicles, maximum of 2 per year, that also will be tax exempt. And if you generate income by buying bonds that are issued by state or the federal government of Nigeria, then the income on such bonds would be tax exempt. We're moving a bit now to the realm of how it affects companies and businesses. In the Act, NTA, a small company is exempt from CIT, meaning that if you have a company and your company qualifies as a small company, then you do not have to pay taxes at all. And that is defined as a company that earns gross turnover of 50 million or less per annum, with total fixed assets that does not exceed 250,000. So if you have a company that meets this criteria, then you do not have to pay taxes. Now, something that we should notice that there is this Nigerian Tax Administration Act, which I also mentioned, that has a definition for small company as well. And today, given how the acts are written, the definitions are not exactly the same in terms of the turnover. And the portion on the Nigerian Tax Administration Act deals with companies that have obligation to do VAT filings. So that talks about 100 million gross turnover. We will need to have clarity provided on this. I personally believe that the intention of the drafters of the bill is to have under the NTA not 50 million, but 100 million, which will further raise the bar for companies that are exempted from paying taxes at all. But strictly speaking, that is not what is in the law today. Hopefully, by way of clarification, guidelines, or a revision of the Act, this can be clarified. But the import is for us today to think that, okay, that you could consider as an individual formalizing corporately some activities that you do today, bearing in mind this structure in a way that you could legally avoid having to pay taxes. If you are carrying out these activities on your own as an individual, and then maybe you are involved in different activities, maybe it's catering, fashion designing, your salary and all that goes above maybe 50 or 100 million. If you enter the tax bracket, as we have seen, then your rate of tax could over 50, if you go back here, over 50 million chargeable tax, you'll be paying at 25%. Meanwhile, if those activities that you conduct You formalize them by creating maybe a so fashion limited. You separate that into a separate business. You create another one. Maybe it's catering services. And the turnover falls below this. You will discover that you will not pay any tax at all on all those incomes. So those are things that you can think of in terms of how you may adapt and position yourself. That is what a number of people are doing now in order to put themselves in good stead. Now, this is a bit like what I've been talking about. Small companies are subject to 0% company income tax rate, so they don't have to pay CIT. For other companies, the rate will be 30%. That rate could become 25% in future, based on if there is a recommendation to that effect from the National Economic Council assented to by the President. But to note, having no tax to pay does not mean that people should still not do their tax filings, because government needs the data, the information, not just to collect revenue, but also for tax planning, policy formulation, and all that. And coming to capital gains tax, as we have seen, small companies are exempted from corporate taxes. So if some of those activities, you carry them out by way of a formalized company structure, and you don't surpass the threshold for taxes, then taxes that you will have paid as individuals, you could very well legally avoid them. For businesses today, under the Nigerian Tax Act, there is a new development levy, which essentially replaces today, like education tax, the Nigerian Information Technology Development Tax, and that with NASENI, which comes to 4%. But to note that small companies and non-resident foreign companies are exempted from this. I talked about this as part of a previous slide. If you bring in your dividend income, interest, rents, and all that legally into Nigeria to government channels, it's free from tax. If you have income from bonds issued by state and federal government, it's free. But if you receive dividend income, then locally it will be subject to withholding tax. But that will be your final tax on that aspect of your income, because it is franked investment income. The Act seeks to give priority to certain sectors defined as priority sectors. And for those people in those sectors, a number of tax incentives are provided for them. So you could familiarize yourself with those with a view to enjoying this economic development incentive specific to those sectors that the government wants to grow. And in terms of export income, proceeds of goods exported from Nigeria by any Nigerian company will be exempt if repatriated through official channels. So, by a number of things, depending on where we are, there is the notion of a rule relating to when an expense is to be deductible. And under the current act, it talks of something being only exclusively and necessarily. Now, it only deals with only and exclusively, so it makes it easier in order to claim deductions rather than the taxman saying, come and prove that this is necessary or that this is reasonable in some cases. If you start a business, then all legitimate business expense, including 5 years prior to the commencement, but not for tax-exempt income or where VAT is not charged. Because if you do not charge VAT, then the government will not allow you to claim those expenses. But otherwise, your expenses, even prior to 5 years before you commence the business, you can, when you now start, put them in as part of your deductions for when you start generating income from the business. There are some other things, depending on where we are relating to capital allowances. Today, for those having businesses, you have a lot of categories, a lot of rates. This is essentially now streamlined into only 3 categories of rates on a straight line basis. I would like to talk about the issue of VAT due or customs duty due and not paid. If that is the case, then the tax authority can refuse to allow such costs to be deducted, except the VAT or customs duty due on them is paid. I've talked about the gains on disposal, so I think I will skip this side. Even though today the CGT rate is 10%, today from next month it will be 30%. But let's bear in mind that for some companies it could well be 0, and so it all depends on how it pans out. Most people that will pay CGT today will actually not pay. It is only those that maybe at the end of it will now need to pay, that will now pay at a higher rate of 30% relative to where we are today. As part of the introduction, I talked about part of the objective being to make Nigeria to align with global standards. And part of what is happening globally essentially is that for certain companies, especially those who are members of multinational entities, having gross turnover of about 750 million euros or its equivalent, then if they operate in a part of the world where the effective tax rate is below a threshold, usually 15%, even if they don't pay taxes up to that locally, then the government of where the accounts are consolidated has the right to ask for a top-up tax. So the risk is that for Nigeria, we may have companies that if Nigeria does not impose tax up to this level, then other countries will impose such taxes and it will be to Nigeria's loss. And in my view, Nigeria is responding to that also. And what the Act now says is that for large companies meeting this criteria, or any other company with an aggregate turnover of 50 billion and above in a financial year, that's 50 billion, not naira, not million. Then for such companies, there is a minimum effective tax rate of 15%. And where that effective tax rate is less than that, then there will be a top-up tax that will be imposed in order to make that rate of tax equal to 15%. The definition of effective tax rate, in my own view, needs clarity in the Act because it has 2 definitions that are not exactly the same. But the notion, the principle that is clear at this point is If this effective tax rate is below that, then the company will have to pay a higher tax rate to get up to a minimum of 15%. Now, something on value-added tax. I've alluded to that before, that if value-added tax ought to be charged, but for whatever reason it will not, then the tax authority can refuse to allow either the OPEX or CAPEX, that's the current expenditure, or the capital nature or capital expenditure, if applicable, for tax purposes, except the VAT due is paid. One good thing that this act allows is where a business has input VAT, meaning that you buy materials in order to use them in your production process, and those materials involve you're paying VAT on them. Then now, you also now have products you finish and you now sell. You can offset that cost of your input VAT and recover it, which today is not the case, depending on your output, whether it is tax exempt or whether it is VATable, and in terms of whether they relate to services or fixed assets. So this makes it easier for those companies that have been, so to say, losing the ability to recover their input tax, to be able to recover that under the new system. And also, there is this mandatory fiscalization in terms of merchant buyer solution, e-invoicing. The government is putting in place a system that would enable the tax authority to have real-time information relating to financial transactions. So they don't have to even wait for someone to do the filing. They can, on their own, based on information platform setup that companies are obliged to connect to, which is already in progress now under the current act, not even the NTA, but which the NTA from January now gives further strength and basis to, and even enlarges, so that the government is able to, on this, even the way it's planned, prepare, so to say, beforehand, the expectation of what a company's tax filing particularly should be like, which could make them, if they now get what the person files or refuses to file, to activate the presumptive tax bit, which I mentioned earlier. So here it is, the electronic fiscal system for recording and reporting all supplies. And now the tax authority can deploy these tools, and companies will be obliged to hook up and be part of that. For those that want to refuse, there are steep penalties for trying to refuse the deployment of such technology. So I talked about the Joint Revenue Board before, which talks about, addresses the tax appeal tribunal as well as the office of the tax ombudsman. And that's important. It's the first time we're having that in Nigeria. So you can liaise with the office of the tax ombud, and then on behalf of taxpayers, you will act as an independent mediator to review and resolve complaints relating to taxes, levies, duties, or similar regulatory charges. So it's about 8:30. 1 hour since we started, as has been said. So I would like to conclude with this slide, that the reforms introduces a number of incentives for small companies because the government wants to encourage small businesses to actually grow. Individuals who are not able to pay taxes, not to be within the tax bracket, encourage people to formalize, have businesses. Then when they have the capacity is when they start paying. But the benefits that will accrue, I would say, it will depend on strict compliance and proper record keeping. Depending on your situation, if you think you can adapt on your own, fine. But if you need support, it will be worthwhile to consider engaging tax professionals who will be able to maintain accurate filings and all that, so that you'll be on the right side of the law, and also be able to advise you on how to position yourself and make the most of this in order to also profit from the change or the changes that we are having today. So thank you very much for listening to me. Thank you.
Thank you so much. Could we please appreciate our speaker for tonight? Thank you so much. Thank you so much for the wealth of knowledge, and thank you for the knowledge you have shared. It's time for question and answers. I can't find any in the chat box. If you have any questions, please, could you please raise up your hands so we could call you and so that you can ask your questions. Okay, you have one hand up already by Austin. That's number one. So Austin, you can unmute your mic and go ahead. Okay, you have also another question. You could put your Chinagorum, you could please put your question in the chat box. But Austin, go ahead with your question.
Hello.
You are not audible, please. You may need to speak up.
Am I audible now?
A little better now.
Okay.
But if you can do more, if you can speak up more, that would be great.
Okay. I want to ask a question. I'm sorry, shouting. I don't know why it's that. But if you can hear me, just manage. I have a friend who runs a limited liability company, and I have another who also runs an enterprise. So there has been this debate: who is going to pay more? Is this the guy from running a limited liability company, or where we are doing our business as an enterprise? And there has been a lot of information flying around. So I want to hear it from the mouth of an authority. What's the tax outlook in terms of each sector, a limited liability company and just a business name registration?
I don't know if you got the question, Mr. Oluwole. Did you get it?
I think the question is, if someone is running an enterprise that is not a limited liability company and is subject to tax, who will pay the tax, or who will be the taxable person? That is what I think the question is. Is that correct?
Is that correct, Austin, please?
Yes, partially. The second part is which setup is better, because they are pressuring us to move from an enterprise to a limited liability company. There will be tax advantage. So I want to know, before I make that move, is there any tax leverage moving from enterprise to a limited liability company?
Okay. During the course of the presentation, I think I gave an example of maybe an individual has a catering business, has a fashion designing business, has some other businesses, and then is mixing them all together. They are not registered as a company. So even if they are enterprises, in the eyes of the law, that person and the business are one. The business is not a separate legal entity from that person. And that person will now be subject to tax. And because it's an individual, subject to tax is the personal income tax rate that will apply. And that, as we have seen, will vary from coming from next year, maybe 0 to 25%, or under the current regime, 7 to 24. Now, a person in that situation could consider setting up companies for various activities, like I said, knowing that for small companies, the tax rate is 0. So if you structure and you have these businesses into various companies, depending on your turnover, you might need to consider some things. But if your turnover is lower than 50, which we believe will be 100 million, when the clarification, as I said, between the NTA and the NTAA is done, then it would make sense, apparently, to have these companies, because you would avoid taxes legally avoid taxes that you would pay as an individual today. But of course, you also have to combine that or assess that together with what it will cost you in terms of now setting up the companies and all the filings you will need to be doing, because you now have a corporate entity. So you might need to look at all this together in order to decide or know what is optimal for you. And that's why I also said you might consider engaging a tax professional, because with more details, you may be able to now really determine what will be the best trade-off for you in this instance.
Okay, thank you very much. We have 4 questions in the chat box. We're going to take them now. But just before we take them, we have another hand up. Well, we just take that hand up and we will take the 4 questions in the chat box. Okay, the second hand, it's by, okay, Mr. Godson Uzuku. You can unmute your mic, sir. Good evening, sir. You can unmute your mic, sir. Good evening, sir.
Good evening, Michael, and good evening, Wale. Quite interesting this discourse this night. Thank you so much. I just have questions on cooperative society. You, from the presentation, said cooperative societies that are registered are exempted from this tax regime. Now, I'm going to look at a cooperative society as a body and individual investors within the cooperative society. If I belong to a cooperative society as an individual and I'm making an investment, and my investment dividend, my investment or whatever fixed rate, whatever it is, the dividend interest that comes out of it is more than 50 million, 100 million, so to say. Is that taxable from the individual point of view? That is one. Number 2, with respect to the corporate body inside, the multi-purpose cooperative society, do they have a limits in terms of how much can be taxable, not taxable, if you're exempted? Because the way is the word exempted from what? All, no matter how much revenue they get, no matter what they get, is completely exempted. That is number 2 in terms of the cooperative society. Now, a cooperative society, again, is that especially for agriculture. Are there any tax exemptions or reliefs for cooperative side that are related to agribusiness? Thank you.
Okay, thank you very much for the questions. In terms of the cooperative society registered under any enactment or law relating to cooperative society, income of the society itself is exempt, and where it distributes such incomes to members, that also will be exempt. I'm talking of the dividend in the hands of the recipients, given that it's a cooperative society and it is properly registered under the law. And when it says that it is exempt, it's talking about exemption from its taxes. Let me give an example. If a cooperative society registered buys shares in a company or places money with a bank and earns interest, the bank will subject the interest income to withholding tax, irrespective of whether the cooperative society is registered or not. They would deduct that in remitting to the cooperative society. So the exemption is more of the income at the level of the cooperative society itself. And the Act encourages or seeks to encourage a number of businesses. Part of that, thank you for the question, is that there is a tax holiday for the first 5 years for agricultural businesses under the new Act. So if you go into crop production, livestock, or dairy, for example, the first 5 years are completely free. Maybe I can go to I think you're still seeing my screen, right?
Yes, we
Hello?
can. Yes,
So,
we can.
I'm showing some things from the backup slide just to, if you look at number 24 here, it talks about tax holiday for the first 5 years for agricultural businesses such as crop production, livestock, dairy, and so on. And we also see here some other benefits. There are actually up to about 50 of them. We didn't have time to go into and elaborate on all of them. But all these are things that under the new Tax Act would be exempt from various forms of taxes, maybe stamp duties, VAT, withholding tax, development levy, and some others. So specifically on the agricultural business question, for the first 5 years, yes, there's a tax holiday for them. So you could well venture into agricultural business if it pays you, knowing that you have a tax holiday, even if your profit is 1 trillion for the first 5 years, you will pay no taxes.
Okay, thank you very much. Let's go through the questions in the chat box. We start with number 1. Please, how is personal income from freelancing treated under the law, under the new tax law? Note, the income comes in dollars. Is it taxable? There are a lot of questions in the chat box. So maybe if you take them quickly, then we can take the others.
Okay, thank you. I've gone to this slide here. The middle part talks about income gain or profit from an employment being deemed to be derived from Nigeria, 1, where the employee is a resident of Nigeria, or the duties of the employment are wholly or partly performed in Nigeria, and the remuneration is paid by or on behalf of an employer who is a resident of Nigeria. So if somebody is freelancing, the understanding is that you are working like part-time, but you are getting income, and maybe the person you're working for is a foreign entity, maybe you are a coder or something, and then you spend part of your time working for a foreign entity, and then pays you in dollars and whatever. It's deemed to be derived from Nigeria because the duties are being wholly or partly performed in Nigeria. And in fact, the chairman of the committee saying that what the law looks at is whether the person is earning income, not even the morality. I know that's not the question now, but not the morality of the business itself. It's essentially is this chargeable or income and all that. So I would say yes, such will be chargeable.
Okay, thank you, sir. You have another question. As a housewife, what is the impact of the new tax laws on my account?
Some more context might be useful. If it's a housewife, for example, that is only having some allowances in order to run the home, that is not income per se, because the housewife in this context is not employed. It's just the income of the husband that is being used in order to run the house. But if the wife now, as a homemaker, also runs some businesses, then that would make her in that aspect to become taxable. And then there will be an assessment as to whether the taxable income, whether tax should be paid depending on, as we saw, this slide, in terms of the reliefs, the chargeable income, and whatever. But if it's purely someone who is the homemaker, then the person is not in any paid employment. It's not running a trade. Then in that case, strictly speaking, no tax implications.
Okay, thank you very much. There is another question. Where does a worker who is a freelance person rated in the tax administration?
I think it's a bit similar to the question looked at before, in terms of where the individual is performing that role. If he's resident in Nigeria, that income is deemed to be derived from Nigeria, even though that person is working for someone paying him from abroad.
Okay. Then we have another question. We have several questions in the chat box. Are gifts like 13th month and promotional monetary rewards subject to tax?
They are paid through, from what I understand, they are paid through alongside salary. The employer says, instead of giving you only 12 months, I want to give you like one extra month. So I give you like a 13th month. It is still employment income. And just as all the other 12 months will be taxed, that also will be subject to tax. When we talk of other allowances, it now depends on the context. But if they are not reimbursement of expenses, as we have said here, then they become sources of income. And under the new Tax Act, as I said, it's not just a function of cash payments, even if there is benefit in kind. Let me try to illustrate. Maybe your employer says, okay, I will give you a house to live in, and you will live in that house for free. The tax authority will say, hold on, ordinarily this individual, you will have paid him housing allowance, but now he's living free. He should have spent part of that to rent a house. So employer, you have a responsibility what is the market rental value for the kind of property you are giving to this person, and then nationally that will be deemed as income, which will now be subject to tax, even though there has been no exchange of cash.
Okay, thank you, sir. We have another question here in the chat box. Would this tax system not restrict the flow of cash within the banking system? Many businesses or people may choose to hoard cash at home, thereby encouraging hand-to-hand transactions rather than the formal banking channels.
I think it depends. Remember that there is the TIN, tax identification number, and there is also what was said about bank stockbrokers and others providing information. So some people may feel, well, I want to disappear from the eyes of the law, and so I don't want to have any trace in the financial system and all that. I think it would eventually be like playing a losing game, depending on what is at stake. Because when you start dealing in cash, the cash, one way or the other, has its own risks, which are multi-faceted, I would say. And it will also impose limitations on what you can do. Are you going to say, for example, you want to buy a car, you want to buy a house, and then you will stockpile cash, and then when you want to move it, you will move it. Let's say you as an individual, you don't want to do that. The person you want to pay, will the other party also want to hold cash? Or will that other party, even if you are to pay cash, will the other party selling a car not take the money to his own bank? And he will describe it as sales of car, in this example, to you as an individual. And so the trace will always get into the financial system one way or the other, whether not directly by the person or not. Remember what I said about the rental income. The tenant might be the one wanting to claim the 500,000 rent relief that will now declare that, okay, I've paid this rent. The landlord might not have. And then based on that information, the tax authority can come after the landlord who may not have declared such rental income at all. So I think really it's going to be a losing game. Keep in mind also what has been said about this digital filing, digital platform, e-invoicing, a platform where the tax authority has real-time information as transactions are occurring, not even having to wait for when people do tax filings. So I think the best thing would be to understand the tax laws and seek to position yourself in the best way possible legally to minimize your exposure and make the most of the situation. Many people are not excited to pay taxes because maybe they feel others who should pay are not paying, or what you pay, people are not really using them well. But those are other questions which are genuine, which are legitimate, but which needs to be separately looked at. Thank you.
Then there is a question in the chat box. Thank you for the response on the multi-purpose cooperative society. Please, what about the question on the interest, not dividend? The interest accrued to the cooperator based on his or her fixed investment.
My take will be that the interest is is free from being subject to deduction. I don't think your cooperative society, when you make a deposit with them and they compute the interest, I want to believe that they credit you with the full value. They don't subject your interest to withholding tax as a bank will do. So that will be my take on that.
Okay, thank you.
The interest on the deposits will be free as well.
Okay, sir. You have two more questions and that will be the end. I made an investment in the money market. There's a dividend on it. Is it taxable? The money invested is less than 150K.
The money invested is less than 150K.
Correct.
The understanding is that for investment in mutual funds, then the income or the increase in the investments relating to that will not be subject to taxes, unlike that of the investments or that somebody may make maybe on dividends or with a financial institution, provided those money market funds are mutual funds that are approved. We might need clarity on this, but my understanding today is that such would not be subject to withholding tax, because your mutual fund holder organizers, when they do their net asset value computation at the end of each month, they will credit your accounts with the interest you get. And that interest you get should be after deducting their management expenses and all that. And they credit that in order to increase your holding in the mutual fund. And if you need to make a withdrawal, you can fully withdraw that amount. It is not subjected to an interest that is deducted before it is credited to your account, which you can fully withdraw.
Okay, thank you, sir. The final question says, if the freelancer is chargeable, will he or she, I think it's the person who asked the question about freelancing earlier. This is the final question. If the freelancer is chargeable, will he or she be rated or charged like a permanent employee?
Permanent employee in this context of the foreign entity, just for me to understand the question, because like we said, employers have the responsibility for their own employees to do a tax filing for them based on what we have here. And then the employee will top up that for additional income. So if this person is a freelancer, it means he's not in the payroll of that employee, of that employer. So the employer should ordinarily have nothing to file because the person is not engaged full-time. From the employer's perspective, it is more like I'm paying someone who is like providing a service to me or a consultant. It's not an employee in the classical sense. And for the freelancer, there is no letter of engagement or whatever, so it's not an employee. It is just someone that is like carrying out a trade, generating income. And so he will just do his own filing as an individual.
Okay, thank you very much, sir. Once again, can we appreciate our speaker for the night? Thank you so much, Mr. Oluwole Oladimeji. Thank you so much.
Thank you.
We are
Thank you,
sincerely
sir. Thank you,
grateful.
everyone.
Thank you so much for the time. And it's 1 minute to 9. So I just want to say compliments of the season to everyone. Thank you for joining. We will share some of these materials to you also in the WhatsApp group so you could join. Thank you so much. And we wish you all a happy new year. If we don't see you again, we will meet third Saturdays in January. That will be the next session, every third Saturdays of the month.